Welcome everybody to this week's episode of DoubleLine Minutes. This is episode 200. It's Fed Week, and I'm Eric Dhall. I'm here with Ryan Kimmel.
Yo.
It's 10 a.m. Pacific on January 31st, 2025. It's been a roller coaster start to the year thus far. So let's jump into the bloodless verdict of the market and see how we're doing. Pretty volatile week in stocks. Kind of miraculously, the S&P is actually up 20 basis points on the week. But the tech sector, one of the high flyers, is down 2%. For all our listeners out there who weren't following, there was a big development in the AI world where a Chinese firm came up with a purported cheaper way of creating these AI models, and it's yet to be seen whether that new model was a true innovation or if it was using some of the American AI models in a process known as distillation. If you want to look up a word of the week, look into AI distillation on how you can use models to train models. But anyways, there's a lot of debate on whether this is an innovation, whether this is a fraud. There's geopolitical implications, but it created a big shock in the market. NVIDIA lost over $500 billion in market cap on that news. So, I mean, it was definitely one of the big catalysts of the week from my point of view. Kind of moving down to other sectors. If you look at the ComServe sector, up about 2.5%. Consumer discretionary up about 2.5%. Energy down 3% on tariff talks. There's a big debate in Washington right now if the Trump administration is going to put tariffs on Canadian oil and gas. There's also been a lot of talk of wanting the oil price to drop right now as we sit here. WTI crude's trading about $72 a barrel. Rounding out, that kind of rounds out the week. I think that's really the big takeaway is, stocks are incrementally up, but realistically, it was a volatile week. So that's kind of my takeaway from the week in equity land. What do you think, Ryan?
Yeah, it was a bit of a roller coaster, as you highlighted. I thought the most level-headed note I saw on the whole DeepSeek issue this week came from David Zervos from Jefferies, and he fully admitted in the note, he was like, up until this weekend or the previous weekend, I hadn't even heard of DeepSeek, but he spent the next few days reading the top experts on the subject, and what he came away was he saw experts that said it's a game changer, could lead to major efficiency gains in compute, and then he saw experts on the other side saying it's it's not a big deal. But what he was saying is that the main takeaway though is if this is a game changer, it could be a pretty significant enhancement to productivity, which would boost potential GDP, and in the end would put downward pressure on longer term inflation. So I thought that was the most interesting dynamic or note I saw this week on the subject.
Yeah, definitely. That was the kind of topic du jour in equities. Moving on to the fixed income space, this week we saw a little bit of a rally in rates. Not a huge one on the back of the Fed week. The word of the week in Fed week, and that's the topic of the week, so we'll spend more time on that, but was no hurry. If you watched DoubleLine CEO Jeffrey Gundlach's interview on CNBC, that was the word of the week. And I tend to agree with that. The Fed is kind of sitting patiently, sitting on its hands, and the interest rate market kind of rallied slightly on that. So that leaves kind of the big indices. The Bloomberg aggregates up about 63 basis points on the week. Governments are up about 65 basis points on the week. Mortgage-backed securities up about 80 basis points. Investment-grade corporate bonds up about 60 basis points. High-yield debt up about 30. One loser is the bank loan market. Looks to be maybe flattish on the week. The flattish to maybe slightly down. And emerging market bonds also rallied up about 60 basis points. So positive week in fixed income land. And one of those steady as she drifts meetings at the Fed, no changes in interest rates, and a very staid press conference. We'll have to wait and see. Moving on to the commodity area, the Bloomberg Commodity Index is down about 1% on the week, and the big driver, that's energy. The energy component's pulling it down about 5%. But precious metals are up 2%. And gold, as we sit here recording this podcast, spot gold is trading near an all-time high of over $2,800 an ounce, a troy ounce. So gold is up 1.5% on the week, and that leaves it up 7% on the year. So kind of some interesting motion there in the commodity markets, a little bit of a dichotomy between oil and gold. And for all the crypto bugs out there, as we sit here, Bitcoin's sitting about 104,500, and the dollar index is sitting at 107.9. And that kind of wraps up the bloodless verdict of the market for the week. And we'll kind of roll into the macro. Pretty interesting week. A lot of macro stuff. And the topic of the week, which is the Fed. So, Kimmel, why don't you kick us off?
Yeah, so heading into this week, as you said, the Fed rate decision on Wednesday was the main focus, and I would say it was a bit of a non-event. The Fed didn't make any changes to its monetary policy, as was largely expected by the market. There was some hawkish undertones in the statement. They changed some of the language where they removed a key phrase saying that they had seen progress on the inflation front. So progress meaning that inflation decelerating, heading towards their 2% target. So the market kind of digested that to be more of a hawkish comment, and you saw rates kind of temporarily spike higher following the release of the statement. But then during Powell's press conference, it kind of just all reversed back to where they started before the rate decision came out. But yeah, I'd say it's steady as she drifts. It's really up to inflation now. Inflation is in the driver's seat, and the Fed needs to see more progress on inflation, moving back closer to that 2% level. And it just seems like they're not really comfortable with the trajectory of inflation right now. It's been hovering up in the high 2%, depending on which inflation measure you look at. Look at core CPI, it's still a 3 handle, but it's really the direction, and it hasn't really moved lower over the last 3 to 6 months. So I think they're saying let's keep rates as it is here, and let's let inflation prove to us that we're on the right track.
Yeah, I mean, realistically, looking out at the kind of interest rate probabilities as imputed by the market, there's only maybe 2 cuts priced in, and the first one isn't even expected until the summer. It's a dicey, it's 50-50 for there to be even a cut in June, based on the current expectations. So that definitely put a damper on things. And Jeffrey Gundlach was out there on CNBC saying he thinks the bogey for cuts this year is more like 1, but we'll have to wait and see. But that's early in the year, a lot of developments, a lot of uncertainty, especially with the new political climate. But yeah, with that, maybe we can look at some of the macro data that dropped this week. What do you say, Brian?
Yeah, let's do it. So on the macro front, it was really, the data was backloaded. The more important data releases came out in the back half of the week, and particularly this morning. So to start the week, one of the more key data points came out on Tuesday. You had durable goods orders. The headline number came in a bit weaker than expected, but that was driven by the volatile, transportation sector. If you strip out transportation and look at durables, ex transports, you did see a nice, robust, positive 0.3% improvement on the month, which is in line with expectations. And another key takeaway from that release, I like to look at capital good orders, non-defense, aircraft. And compare that with the same measure shipments. And both measures came out strong during the month of December and have actually linked together a series of pretty strong months. We've seen both new orders and shipments move higher. And you're seeing new orders actually outpace shipments to a degree, which tends to lead to better in business investment data. So perhaps we might see a little bit of an uptick in Q1 in business investment. On Tuesday, we also got home price data from S&P CoreLogic, the Case-Shiller. We saw home prices, the 20 city, month over month increased by 41 basis points. That brought the year over year number to positive 4.3%, which essentially we're back at a run rate that's consistent with the pre-pandemic levels. We also got consumer confidence numbers from the Conference Board. We did see a slight tick down in the January data. That was consistent with what we saw in the University of Michigan consumer sentiment data. And when you look through the details of the Conference Board report, it was primarily driven by a decline in consumers' perception of the current situation, which declined quite a bit. Expectations were a bit more stable, but by and large, not too much to read in from this data. On Wednesday, as we said, we had the Fed rate decision, and then on Thursday, we had a few data points. We had Q4 GDP, which is kind of interesting. The headline number came in weaker than the economists were forecasting. So it came in at positive 2.3%. That's quarter over quarter annualized. Economists are expecting 2.6%. But when you look at the components, it was really driven by very strong personal consumption. Personal consumption ran at a hefty pace of positive 4.2%, again, Q over Q annualized. So a very strong rate, and that was really driven by very robust consumption in the goods sector, specifically in durable goods. So in the fourth quarter, the consumer was alive and well, as I said on some of our internal calls. On the business investment front, though, a bit of a weaker read on the economy. We also had jobless claims on Thursday. Jobless claims declined to 207,000. It's been pretty volatile over the last few weeks, just given the wildfires in.
We could use some wildflowers, man. I mean, that sounds better than these fires we've been dealing with,
I hear you, man. I hear you. But regardless, the fires have been driving some volatility in these jobless claims data. In California, saw pretty significant spikes a couple weeks ago, and those were reversed. But when you kind of pull out the trend, I say there's really not too much to glean as far as a negative read on the labor market from the jobless claims data. Still looking pretty benign. And then this morning, we got some interesting data on the wage growth and inflation front. I will start with PCE, the price index. And I think generally it was considered a softish read on PCE prices. You had the headline, which came in about 16 basis points month over month change. The market was expecting 0.2. And when you look at some of the when some of the economists, they estimate out the 2 decimal points, they were a bit higher than what actually came out. And then when you're just looking at the trend of core PCE prices, it's really coming back down towards the Fed's target. So on a 3-month annualized basis, Core PC is running 2.2% on a 6-month annualized basis, 2.3%. So that's a, much improved compared to those year-over-year numbers, which I see core PC still at 2.8, and it's been hovering in that level for a couple months now. But what I will say is that the January data that we get next month, end of next month, is going to be interesting because we have a pretty significant month-over-month print. So we have, I'd call it positive base effects starting to work into those year-over-year numbers. So that could help that headline year-over-year over the 1 month to say a couple months out. Another important data point that was released this morning was the employment cost index, known as ECI. That came in at a positive 0.9% quarter-over-quarter gain. On a year-over-year basis, I think it was 3.8%. This is down from a 5 handle that we saw in 2022. So it's looking like we're getting some nice deceleration in the wage growth numbers. That should make the Fed pretty comfortable kind of with the path of wage growth and how that feeds into their inflation reads. And if you look at other like leading indicators for wage growth, like the quits rates, that's signaling that we should continue to see a deceleration in wage growth numbers in the quarters to come. I'd also highlight personal spending came in very, very strong in December. It kind of lines up with the strong PCE number that we saw in GDP. Incomes also remain pretty strong as well at 0.4%, at 0.4 month over month. And when you look at year over year and on a real basis, personal incomes running around 2 to 3%, which should continue to support consumption down the line. So overall, pretty good read on the economy from the Friday morning data.
Yeah, I mean, definitely, December was positive. GDP is humming along at a pretty strong rate above what economists expect the U.S. can sustain over the long term. So I would say it was a pretty positive week from an economic standpoint. And I would also say the Fed sitting on its hands, not in a hurry to do anything, has kind of maybe given a little bit of stability to the interest rate market and kind of squash some speculators for at least the next few months. So we'll see what happens, but a lot of winds of change are blowing through the world right now, and we just have to wait and see how everything develops. And kind of looking ahead to next week, we got some interesting stuff, but I'd call it like a kind of moderately busy week. We get ISM manufacturing. The prior was 49.2. The estimate is a little higher, but still below 50. We'll see about that. We get jolts, to kind of look at the labor market. The prior was about 8,100,000. We get the ADP employment change. That's not that useful an index because it doesn't have a great correlation to the jobs data that drops Friday, which is by far the most important data we're going to see next week. Naturally, we're going to get the initial jobless claims on Thursday. With the continuing claims, as Mr. Kimmel has mentioned, that's been volatile due to the wildfires. So maybe put that one aside, but definitely take a look at that January change in non-farm payrolls. Very important data print. The prior was over 250,000. The estimate is 150K, so big drop, but we'll have to wait and see what the print is. Unemployment rate's predicted to be unchanged at 4.1%. And we also get the University of Michigan sentiment surveys along with the University of Michigan inflation expectations. The prior there was 3.2%, so still above the Fed's target. I definitely think the Fed wants inflation expectations to become more towards their 2% target. So we'll see if any progress is made. And that kind of wraps up the week. I want to thank all of our listeners out there for sticking with us.
Yes, thank you to all our listeners out there on DL Minutes. Hit us up on X at DLine Minutes or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
Yeah, and you can find more information on our website, doubleline.com. Don't forget to subscribe to our YouTube channel. Also, take a look at Jeffrey Ginlock's CNBC interview. We also have some if you haven't taken a look at the Roundtable Prime, that's definitely something to take a look at, to kind of food for thought. Definitely could maybe glean some ideas there. And once again, want to thank you all for tuning in, and have a great weekend.
Yes, everybody. Have a great weekend. Thanks for tuning in.